Hi, everyone. Welcome back to the Commercial Real Estate Library. I'm Dama Tamanawala, Garrett McGilvery, and today we are joined by the Managing Director of Real Estate for PSP Investments, Chris Wojtecki. Hi, Chris. How are you?
Hi. Good. Welcome. Thank you.
Good, Chris. Chris, we always like to start with a little background of our guests. Can you tell us a little bit about your role and a little bit about PSP as well?
Yeah. So my role is, as you said, managing director. I co-head the Americas. We have about a team of 30 investment professionals in the Americas team. We're a global investor, and PSP Investments is a pension fund. And we're a Crown Corp that represents the Armed Forces, RCMP, the Army Reserves, and the public sector. So it's a pretty great mandate to bestowed upon us, and ultimately our focus is a group. Obviously, we have multi-disciplines within PSP, and my focus is in the Americas.
Wow, yeah, it's a huge responsibility. We had Natalie Paladichev on here the other week from Ivanhoe, managing the Quebecers' pension money, and now the Mounties money and all, a number of different Canadian organizations totaling 170 billion in is it 170 billion in net assets as of last quarter, I think.
Correct. That's right. So real estate, roughly real estate's about 24 to 25 billion in terms of NAV, on a 14% allocation of the total fund.
Okay. Wow. Okay. Okay. Now Garrett and I can't have anybody on here with less than $1 billion in assets under management.
Yeah, that's
you put the bar very high.
Chris, can you just give us a bit of a background on sort of like what you guys do with real estate? Like, are you guys invested in Canada? Are you guys invested globally? Just give our audience a bit of a background.
Yeah, we're global investors. So ultimately, we have that global mandate, which is great because certainly in a low yield environment, we need the entire globe to find where the yield is, and certainly that's important for us to deliver that mandate. When we look at our portfolio, we're about 95 to 98% that's in the direct investments. So we are very active in our investments. But what I would state is we're very partner-centric. It's really important for us in order to have the top-notch partners in order to help deliver us the returns, given the size of the fund. Clearly we need to leverage the expertise, and certainly what we tend to lean towards is entrepreneurs. We like the entrepreneurial spirit that someone brings to the table, and again, that's really from the standpoint of they have real skin in the game. So alignment is a big aspect for us, and that's been a kind of a DNA for the group that's been there since day one and proved well for us. When we look at what we have in the Americas specifically, we're roughly about 60 to 65% allocated into the Americas. That's obviously U.S., Canada, Mexico, Brazil, Colombia, so on. So we have a pretty large footprint, something that is again advantageous for us in terms of finding yield on the proper risk-adjusted return.
And can you put it into practical terms for us when you talk about you have these partners that you entrust and rely on and have direct investment in real estate? How does that happen? Maybe you can talk about it in terms of your Washington Wharf project. Do you have an asset manager? How does that happen?
So that's an interesting project. It's just to give a context to the audience, it's a 3.2 million square foot mixed use development in DC on the waterfront. We control 1 mile of frontage of water, which is pretty interesting. We also have water rights. There's a lot of jurisdictions there, but ultimately there the partner is a local partner called P.N. Hoffman, and this is a local Washington D.C. developer who started in the condo market and transformed his business and his company into a mixed-use developer. And was a site that was through an RFP process. He had partners, and frankly, we were just fortuitous to figure out that deal structure that was right for us and the way we viewed it. At the time, it was not an obvious deal, right? It was in an area that was gentrifying. Most people couldn't see the vision that Monty Hoffman, who is the founder of P.N. Hoffman, had for that project. And, our team was able to, see his vision, and we were able to structure it in a way where we felt comfortable from a risk perspective. And ultimately, that's just the team sourcing, relationships and finding great relationships that are out there, right? We look for sharpshooters in these markets, especially on these complicated mixed-use projects. You need that principal involved and hands-on and digging in, because it's a 24/7 sport when you're doing these projects, as you guys are aware.
Yeah. And I'm just thinking, like, how can you talk about some of your partnerships in Canada?
Mm-hmm.
Some of the groups that maybe our audience might know, and some of the projects that you're involved with here.
Yeah, so in Canada, we're in partnership with Oxford as an example. We have an asset in Toronto where we're partners together. In addition, we have a partnership with Crestpoint, and specifically looking at industrial in that space, and that's been pretty productive for us in terms of a strategy. In addition, we're partners with Starlight on the residential side in the GTA area. So those are the kinds of the partners that we have in Canada that people would be familiar with potentially. In addition, one of the larger projects that we have or holdings is a piece of land called Downsview. It's the Downsview Airport.
Wow.
That's about 365 acres. It's on the 401 and Allen Road. And, we acquired that land, 100% solely PSP without a partner, and actually decided to create a development company specifically for that project called Northcrest. So, we're nimble in what we see and how we approach things. So we typically that was a unique situation. Typically, we like to partner with entrepreneurs, like I said, and that one was a unique circumstance where we felt that going from scratch was the more appropriate way for that specific investment. Yeah,
Garrett and I will certainly be watching what happens at that project.
Yeah. It's a huge opportunity, for the GTA region. When you look at its location, it's really in the bullseye of the GTA and surrounded by 3 subway stops, a GO train. We definitely feel it could be let's call it a relief valve for the region for various uses. So it's an exciting opportunity for everyone to be involved in.
Interesting. Okay. And last point on this, partnerships, how it all works. And I appreciate you helping us out here. How does it happen? Like, you mentioned Starlight, Crestpoint, these are now big institutions in my eyes.
Right.
How does it happen when somebody wants to partner with you? Is it that they've, it's already established that you guys are going to go, take on some projects together, or is it, I go out and tie up a portfolio of apartment buildings and be the asset manager for 10%, and PSP is. Do you understand my question?
Yeah, I understand. Yeah, I understand. How does the sausage being made here in terms of the institutional? So look, there's various ways it happens. We do get inbounds on, let's say, recapitalization events where someone, operating partner or a GP, there's there's a fund life or there's a LP that wants to monetize. There's opportunities that come in on that front where we can look at that. We typically try to stay away from that. We've done that on a very select basis. And in addition, as relates to, going out on more of a programmatic venture, certainly the first thing that we do is we identify what's the strategy that we're looking at. What are the trends? What are the sectors that we want to hit? And we take that approach from the beginning from a portfolio perspective, because otherwise, if there's just too much inbound coming in, right? And we need to know what we want, right? We don't want to be necessarily sitting back and thinking, oh yeah, maybe not, because we just won't get to where we want to go from a portfolio perspective. So I would just say, before we go look for partners, we clearly identify specific geography, cities, sectors, as mentioned. And then that helps narrow down the path of, what partners are out there, right? And then, we do dating at the end of the day. We get to know, the organization. We get to understand their track record, the way they approach things, a bunch of due diligence on the partner, right, before we kind of, go through a transaction. That's in the beginning of a relationship. Obviously, when a year or 2 or 3 goes by and you have some operational data and the teams are able to work with each other and get to really know a partner, when you go through some of the tougher times and how people handle themselves, it really becomes then very easy to run the investments through our process at PSP. So that's I don't know if I answered your question, but there's various ways. But again, it's really a variety of people that are looking at their respective markets or sectors in our team, and they're the ones that are establishing those relationships. And we're very relationship driven, as I mentioned, because our operating partners are the ones that are helping and really primarily driving the return for us at the asset level. So it's really important to have the right partner selection. Yeah,
and Garrett was telling me, you guys do have ridiculous returns for the size of the behemoth size of capital that you have. So it's very, very impressive. Okay, into investment strategy.
Sure.
So we're in the middle of a pandemic. For those listening, we're recording this on the day after the election. We still don't know what happened. How is the pandemic influencing your real estate strategy? The combination of money printing, the work from home, everything that you guys are thinking about.
Yeah, so the pandemic, in any situation that we find ourselves, we don't want to be too reactive as an investor. That's the worst thing you can do, is be too dramatic about what's going on and so on and so forth. So you want to be patient. You want to be thinking about where things may or may not be going, and revisit your theses, right? And to that point, with the pandemic, we're in a pretty fortunate spot, I would say. We're in a lot of sectors that we want to be in post COVID. So, for example, we're in the studio real estate business. We've been in that business for over a year and a half now. And that's a really good sector to be in when you think about all of the over-the-top production, the OTTs, the Netflix, the Hulus of the world. You think about all the content, the absorption of content from customers and consumers. I think in March, the stat was 34% Netflix consumption in terms of viewership in March, right? So that bodes well for studio real estate. And when you look at the competition in there from some of the non-traditionals, that really ultimately is great from a supply-demand balance, right? So when you look at Toronto, for example, they're at full utilization, right? So that's a tight market that does $2 billion of production content. When you look at Vancouver, same thing. Vancouver, so we know that there's supply demand imbalances in our own markets in Canada, right? And then we have studios in LA, same type of issue there, right? So again, these are trends that we try to identify and look at that. So post-COVID, studio real estate, great place to be. The other sector that we're in, again, we've been in this for over 2 years, is life science. When you look at what's going on with the pandemic, and you look at what's taking place pre-pandemic, but certainly that's been accelerated with the pandemic. There's going to be a lot of money that's going to be flowing into the bio space, right? And the infusion of the bio and technology is also an interesting trend, right? So I think, again, the stat there really quickly is in the US, there's $30 billion of venture capital funding that's going to go towards that space. And the growth rate is tremendous. When you look, again, supply demand balance in Boston, which is really the center for bio. When you look at the overall markets, Cambridge in Boston, the vacancy rate on a 25 million, call it 25 million stock roughly. The vacancy rate there is 1%. Again, another area post-COVID that we feel very confident on, and we're happy to be in it already. So we're just in that process of doing deals in that space.
Very interesting. And sorry, just before you jump in, Garrett, just to clarify, are you talking about like laboratory space or?
Yep.
Okay.
Yeah, life science. Yeah, life science space. So yeah, exactly. Not production, right? This is where they're doing the R&D specifically. There's maybe some light production in there, but not full R&D facilities where they're doing, all of the let's say making of antibiotics or medicine and things like that. I mean, so again, our mandate is we're fortunate in having the ability to, when we spot something, to be nimble and go after something that we see as a trend. And that's based on the way our culture is facilitated in our group. This is the things that we discuss a lot, right? Weekly, daily. Where should we go? What's the next thing? Where are things going in the next 3 or 5 years? We want to be ahead of the curve, right? And that's based on just our team, having the discussion and challenging each other on where to go. And so, when we look at that, so I'll give you an example. Take the life science space, right? It's a space that we looked at and said, there's a lot of infrastructure that's in these facilities, right? There's a specific uniqueness to the building in terms of how chemical is stored on site, what's needed in terms of life safety, what's the ceiling heights. There's specific unique attributes to the building. And again, when we looked at that, we said, this is a better place to be. The old thought process of not necessarily understanding that, was starting to change. And we said, look, we have to go into this space because we think traditional office, commodity office, it's easily can be disrupted to a certain extent, where life science, we felt at the time, and it's proven to be, somewhat, fortuitous, was not the case, right? And today, when we look at it, more money's going in, and that's just something that when we look at life science, we feel that we're going to be rewarded for that. So again, to answer your question directly, it's these are discussions that take place, and we have to go and be on the offense. Like I said earlier, we don't want to be sitting back and waiting, because if we're waiting and it comes to us, it's probably too late, right? Right. So we have to move forward.
Do you see any other opportunities in some of these, less traditional asset classes, things like data centers, stuff like that are coming on the horizon?
Yeah, so at PSP we are in the data center business as well. However, that's in the infrastructure group. Same thought process though, right? Thinking about where things are going in terms of trends, consumption. Using everything with the cloud. Now we're consuming more through streaming, especially when we're doing Teams all day. But yeah, that's one other niche sector. We're also in manufactured housing, another niche sector that we're in. So these are the areas that there's more operational. Some of these are more operational intensive, right? But we're okay with that, right? As long as we can understand, the business of it and what's driving supply demand, and we can, understand what it takes with the right management team and or partner. These are things that we're comfortable with. Certainly, it pushes us, right, as a team. I mean, in all intents and purposes, it'd be nice just to be buying traditional, let's say, logistics, which we are doing. But when you look at the returns, they're, call it 8% for core on a levered basis. It forces us to go a little bit outside where there's a perceived amount of operational risk, which is driving the returns higher. But we think it's a good risk-adjusted return, and frankly, we think that the trends will outperform some of those operational risks that is intuitive in that business.
Are you able to share what the return would be on, say, like a studio space or a bioscience lab?
Yeah, so I'll give you ranges of what we're targeting, and it depends on the strategy. So, in the life science space, specifically, we're more on the value add side of it. So we're buying traditional low-rise office buildings, and we're shooting for call it 12 levered to 13 levered IRRs. And that's on the value add strategy. There's no cap rate expansion. We're keeping cap rates flat typically. Maybe there's 25 bp cap rate expansion, but that's really where the range is on, let's say, life science. When you look at core life science in the U.S., you're looking at probably a return more in that, again, 8 to 9 levered IRR. The one thing I'll say about life science is now everyone is in life science. So we are starting to, discuss around the table. It's not here today, but in 3 or 5 years from now, will the party be up because the supply demand will be in balance, right? Everyone's getting into the space. Now everyone's a life science developer or operator, and that we have to be mindful of that. But right now we're not worried or concerned, and we're and again, market selection is really important. So Boston, San Francisco, San Diego, Raleigh, Durham, in a research triangle, right? Those are the areas that we're primarily focused on. And again, that has to do all about human capital, right? And it's where the researchers are, it's where the university knowledge centers are, and that's what's driving those ecosystems.
Right. Chris, you made mention of cap rates briefly.
Yeah.
Where are they going?
Which sector? Which sector?
Yeah, good follow-up question. Well, okay. I mean, I guess maybe we can talk about office. Let's take office as a good example, because that's one. I think multifamily. You could argue they're going down. Like a lot industrial perhaps going down just because interest rates are getting cheap. I feel like offices, people are on the fence because you have a lot of these contractually obligated rents. Money is now cheaper, but the income is the same. Where are office cap rates going?
Oh, listen, traditional office, when you look at COVID, no one really knows what the shakeout's going to be. And the reason being is we're still in the middle of this, right? And tenants and decision makers need to need to understand what's important for their workforce. Every workforce is going to have different needs, and they're going to approach it differently. So, I think, on the side of office investing, it was a great, pretty straightforward business, right? In the sense of, everyone pretty much had the same operating model, right? In terms of users, right? And now that's not going to be the case, right? There's going to be flexible work. There's going to be maybe hub and spoke, right? Is there going to be, hot desking as relates to that as, a component of what I just stated. And so what happens to the absorption, or what happens to when the lease starts to roll? What happens on that 200,000 foot, let's say, user? Are they going to take 200 on the roll, or are they going to ask for 150? Right? We don't know yet, and there's not data out there yet. So if you have a long WALE in terms of expiry, look, I don't think there's going to be some cap rate change. So it's you're probably looking at a price differential, right now 5 to 10%. But if you look at New York, it's more than that, right? So it depends on the market. If you're short duration in your lease, given what I just stated, not knowing right where things are. So if you're on the value add side of things, you're probably looking at prices that are 20, 30% down, right, in some markets. So it all depends. There's not a straightforward answer here, and that's what makes that interesting, that sector. Because if you have the right call, and versus everyone else in the market, and you're contrarian in that, it could be a pretty interesting time to go on the offense. But I think it's still early, but it's something that we talk about, frankly, every day. I will say, until there's data, I think things kind of I don't think there's many trades, or the trades are more, let's say, anemic in terms of volumes.
Right.
But as we start to understand where occupiers are, then certainly that's going to help, give confidence within the investment circles, right?
Okay. Okay. This is one of my last questions. Okay. Justin Trudeau is doling out checks.
Sure.
Trump is doling out checks. We got the money printers around the world are running in full volume and full force.
Yeah.
We're going to have to pay this back in some way. Does that influence your real estate strategy at all?
So if you look at all the money printing, it should bring some asset inflation, right? So again, going back to sectors, if you're in the right sector, right, you've got great growth and you have all this money printing, you're going to be in a very good spot for capital appreciation on top of the, let's say, NOI growth that's at the asset level. So that's going to, that should bode very well. And if you're in the favorite asset class like industrial or logistics or life science, there can be, and most likely will be, some further cap rate compression. Residential is another one. And the reason is that investable universe right within real estate is shrinking. Retail is really not investable from an institutional perspective today, right? So you take that out, right? Traditional office we just talked about. A lot of people are going to, not sure where that's going to go, right? So you may have reservations, which then now says, okay, I just want sheds and beds, right?
Sheds and beds. That's exactly right. But okay, so that's the one component, the money printers going, and then the debt that is accruing in the Americas, say, which is the other kind of component.
Yeah.
Does that influence the decision making at all?
So I would say I'll go back to your pay back, and we got to pay it back, right? Comment. What I'm concerned and what we talk about is what happens with real estate taxes, what happens to transfer taxes, what happens to some of the social unrest that we're seeing as relates to affordability. Those are all drivers or levers that can affect pricing, right? And if your transfer taxes going up, that's going to affect values, right? Because it's just included into the basis in the next buyer in terms of their IRR. So yeah, that does concern me, because paying it back's going to be important, right? Unless we continue to kick down the can, but eventually I think it will be an issue, and it's just a matter of when.
That can seems to be all the way down the road. There's a highway in front of us,
Yeah.
The can's a dumpster
now. What advice do you think yourself in 10 years would give to you today?
Ooh.
Whoa.
Deep. We're going deep here.
Yeah.
I would say patience. Be patient, right? I think that's probably the advice I would give myself 10 years from now for today. When we think about the pandemic as an example, right? Working from home, things slowing down. It's just the reality is we're all going to have to be more patient, right? And so that's probably the advice. You're not missing anything, right? You're not missing an opportunity. You're not missing anything as relates to where things are going. You're just going to have to enjoy where we are. I use that as lighthearted here, but live the moment. It's pretty interesting, frankly. Where we are, and I think there's a lot of things a lot of people are going to learn. So enjoying that is what I would also state too: patience and enjoying the moment.
Wow, that's going to be a hell of a guy, you in 10 years. Well, Chris, thank you so much. I know our audience has probably taken a lot from this. Thanks for your long-term view, and thanks for coming on the show.
No problem. Thanks for having me.